Hello everyone, Dave Landry here from DaveLandry.com. This is Trading Simplified. So what we talk about? Well, I want to get back to the methodology in action. And last couple of weeks when I thought about doing this, things were looking a little bit better than they are now. But I think it's important to show you where we are now. And I want to go back and revisit where we are with my next 100 trades. And that kind of brings up the Einstein versus Churchill argument. And that's going to make a lot of sense in just a few minutes. I want to do a brief system update on the TFM 10% system, and then I want to go in and look at the live charts on the S&P 500 and look at some of the other trend things that we look at and type of systems we look at to show where we are now and give you some ideas about process versus event bottoms. Housekeeping, I do take requests. You can send them to davelandry.com/contact. By the way, I do a weekly webinar, and I've been a little hit and miss lately due to my schedule with some obligations for some international work that I'm doing right now with China, and also with the holidays. But I hope to get back on schedule soon. And usually those are Thursday nights at 6 Central, 7 Eastern. You can go to davelandry.com/webinar to register. Register even if the link is old, which it probably will be. If you want the slides from this presentation and all the other presentations combined, plus a bunch of goodies to keep you busy, including some spreadsheets or a spreadsheet, which I'm going to talk a little bit about in just 1 minute. I know you want part of me, right? You can go to davelandry.com/StockCharts. I'll also give you all three of my books in PDF format. On Twitter, if you want to follow me, I'm at TFolleyMoron. And on YouTube, I'm at Dave Landry. All right, let's talk about the mystery charts and the methodology in action. So here is a stock I mentioned last year, and it was a nice little pullback setup, and the parameters, the parameters I should say, are at the bottom of this spreadsheet. And I'm going to reveal the chart in 1 second to show you. So the chart is KNDI, and you had a pullback. And what's cool about this pullback is you also had a TKO, a big knockout type of move within the pullback. And go in and watch the older presentations that I've done on TKO. Go to my YouTube channel and search for TKO, or go to StockCharts channel and search for TKO for some presentations on that. Anyway, entry, stop, and initial profit target are laid out here. And as you can see, the stock began to drop, but it never did trigger an entry. So I took it off as an official setup. As I've said 1,000 times before, I'll get emails from people saying, Dave, I'm down 50 or 60% in that turd you recommended. What should I do? And I look at the chart, it looks something like this. I'm like, I wouldn't recommend a stock that looks like this. And they explained to me that I did 6 months ago, and I realized, oh yeah, it never did trigger. So by waiting for that entry, as I preach, it helps you from putting capital into harm's way. So here's another one that was mentioned last year. CENX, it had a nice thrust from lows, was also kind of a cup and handle. Began to pull back a little bit. The entry was here, stop was down here, initial profit target was up here. Now let's take a look at what happened. These are all direct recommendations from my trading service. And as you can see, this one failed miserably after triggering. So there are my exact trades, and I'll show you all the trades here in just 1 second. Now, let's take a look at SGML. This was, I don't think this was a formal mystery chart due to the fact that I missed the show this week. But anyway, you can see the parameters are down below. The stock was in a real nice trend, and what's kind of cool is, was also an accelerating trend. You can see it worked its way higher, then it began to accelerate higher. It begins to pull back. So entry was here, stop was down here, initial profit target was up there. And as you can see, it did trigger an entry, but unfortunately stopped out. And there's the actual trades. What I like to do is, since my service is based on a hypothetical 100K account, if the service is recommending 400 shares per 100K, I like to recreate that in a model account so I can show you these trades and show you that I actually did take them. Good, bad, and ugly. Now here's one from a while back. You can see that it did bow tie after making all-time lows. Nice little pullback. Also a bit of a TKO type of move. There are the parameters down below. Entries here. Stop is way down here. Initial profit target is way up here. Unfortunately, it took off. It didn't quite hit the initial profit target, but I did take profits a little early on this one. I felt like it was such a gift horse to get that close to the profit target on the first day of trading. So you can see I flipped out half of those shares for a quick profit on that one. But unfortunately, it didn't work out afterwards. There was no follow through to the upside. Now, usually, if I use a little discretion like I did and take profits a little early, I will bump that stop quite a bit. In this case, I just left the stop where it was in not an attempt, but just to sort of mimic what the service did, because it didn't actually hit that IPT in this particular case. Now, in hindsight, of course, I should have bumped that stop quite a bit instead of letting it just stop out. But it is what it is, and that is one of the next 100 trades, and that's the actual trades there. And I didn't realize it, but I picked up a little bit of a tiny dividend there. Now, not a whole lot to write home about, but better than the poke in the eye. Now, trading will really make you question whether you're being Churchill's definition of success or Einstein's definition of insanity. Churchill stated that success is going from one failure to another without any loss of enthusiasm. And Einstein once said the definition of insanity is doing the same thing over and over and expecting a different outcome. Now, if you look at the stocks we just talked about, all three of them overall did not work out. So that makes you question the definition of insanity. Why am I continuing to trade even though these things aren't working out? Well, I'm going to define a little bit of that in just 1 second. Now, if we take a look at the trading service, you could see, looking back at recent trades, you've got a couple of losers in here, obviously. So that's a bit of a definition of insanity. But notice this huge winner that's in there. Now, I know I've kind of beat the dead horse on this, but that was a winner that was left over from 2021 that carried over into 2022 and continued to perform very well in 2022. In fact, without that winner, our performance would have been much worse than it was. We didn't set the world on fire last year, but we did end in the black, which I think is admirable considering that we were, and I guess still are, in a bear market. Yeah, we're still in the bear market. Okay, so here's one of the setups that I was thinking was going to pan out nicely and would allow me to show you that I'm not insane in the membrane. And this is 9, entry 1018, protective stop of 7, IPT 1336. So you can see nice uptrend. It was also accelerating in its uptrend. Also very persistent. Notice that it tends to go up day after day after day. And you could draw a line through most of the bars. Mathematically, that's the same as linear regression, but I just like to draw a bar through a line through as many bars as possible. A little bit of a pullback. Nice little textbook TKO type of pullback here. What's cool about a textbook TKO, when you have a big wide range bar down and a fairly poor close, you can enter just above the high and stop out just below the low. Now, when you take the math on that, the entry minus the stop, and then you add that to the entry, that gives you the initial profit target, which is up here. Now, if you are to put your information in at the aforementioned link, www.davelandry.com/StockCharts, you'll get a copy of the spreadsheet, so you don't have to do all the math yourself. But anyways, you can see that I bought at 1047 is where I got in and flipped out some shares, or half the shares, I should say, at 1302. So let's take a look at another setup, ROIV. You can see nice trend there, and then it did begin to accelerate higher. And once again, we have this textbook type of TKO setup. The great thing about the textbook TKO setup, in addition to it giving you almost purely mechanical parameters that you could use, is that in many cases, if it doesn't trigger, then the stock just goes on to fail miserably and you don't put any capital into harm's way. And if it does trigger, the stock has come all the way back, it suggests that the uptrend is resuming. Now, the reason that it suggests that is because, one, just the fact that the market came back so strongly in of itself tells you it's strong. But the other thing is it squeezes out the shorts. Shorts tend to confuse the issue with facts and short markets that are at high levels just because they're at high levels. Just the opposite of what trend followers seek out to do. And if the market comes all the way back, they get squeezed out. Plus, any nervous Nellies that got knocked out might be tempted to rush back in. And those traders who aren't very disciplined tend to hop out at the first signs of adversity and then jump back in when the market begins to head back higher. So this one was working pretty good for us, but then came back in a little bit today. But let's just see how it shakes out longer term. I was on the pitch on December 16th, and Larry Tentarelli said something really interesting, and it just made so much sense. And he said that there's been a lot of great chart patterns that have failed this year, and that's 2022, obviously, on one data point. And he went on to explain that one data point could be a CPI report or PPI report or some kind of inflation report or whatever. And stocks just get absolutely annihilated. So your perfect little setup, your little textbook TKO like I just showed, or something along those lines, just flat out doesn't work because of a bad report or whatever. Now, yes, bad reports do affect the market longer term, but if you're in a bull market, people tend to shrug off the bad news, or at worst, the market sells off a little bit. Maybe your positions get hit a little bit, but by the end of the day, a lot of times your positions will come all the way back, and the overall market sometimes will come all the way back. So it's the sentiment of the people. Now, I don't suggest you rush out and try to measure sentiment. I think that's a really bad idea. But know that if you're in a bear market based on certain criteria, below moving averages or below the buy line, which we'll talk about in a few minutes, and other things, then you know the market's in kind of a bad mood, so to speak, and you want to be super duper selective. And I'm going to flesh out being selective here in just one second. So anyway, this is the 100 trades going back at least to June. Earlier in this process, you'll notice I have IPO up here. Earlier in this process, I was trying to just show you trades to get 100 trades out. And then I quickly realized that I better just stick with my core methodology for now. Now, anything with core on it comes directly from my trading service. These are direct recommendations from my trading service. And you can see that they haven't done fantastic. We've got one or two decent winners in here, but quite a few losers in here too. Now, here's the thing. If you go all the way back to June, you could see we only made about 6 trades since then. So roughly 1 trade a month, and that's how selective I've been. You can see there is 1 short in here. There really hasn't been a whole lot of shorts showing up, even though we're in a bear market. The market has just been that choppy and been whipsawing back and forth. So even though we've got a few stinkers in here, obviously, I'm not super concerned. I'm more proud of the fact, so to speak, that I actually was very selective and waited, and a lot of times weeks and even months before taking the trade. And I know that if I keep chipping away at it, we'll eventually catch some big winners. And maybe 9 or even ROIV might be one of those big winners. And by the way, the ones in yellow down here are still on, and that's why I have them in yellow. Now, I want to do a brief TFM system update, and then I want to jump into the live charts for the S&P 500. Now, notice that this is, and I have a template, and I'll show you in the live charts that I'll plot these for you. This is Landry percent of close. By the way, this is straight from my plugin. If you want the plugin, like the video, and then click down here, and you'll get the plugin for free. And I always say free for now, but it's been free for now for 2 years. But go ahead and get it just in case I decide to start charging for it at some point in time. So the 10% line, which I often call the buy line, or Landry percent of close is what the programmer named it. In this case, it's set to 90-50, and that's for the TFM 10% system. So at 90%, it is 10% below the 50-week closing high, okay? So 50 is the number of weeks we're going to look for, and then 90 is how far away. This is a percentage. This is the number of periods, and this is a percentage. So 90% would give you that 10% line, which works really well for the S&P 500. to my surprise, when I did some historical testing going back 100 years or so, this little system got you out of every major bear market in history. It doesn't mean that it doesn't have whipsaws, which I'll explain in 1 second, but it would at least gotten you out of trouble. And that's the whole designer's intent, was something to get you out of trouble. Now, my thinking with this is, if a market is going to drop 50%, it's going to first drop 10% first. So if you look at these parameters down here, percent from closing high, you can see that this reference line is set at 10%, okay? And it's set to match the parameters up here. So you could see from this closing high down to the low, the market was down about 25% or so. Obviously about 30% peak to trough, but on a closing basis, down about 25% or more. So again, my thinking is, once a market drops 10% or more, you probably want to think about getting out of the way. Now, I do have a whipsaw filter, and that's the 50-week simple moving average. So for a sell signal, the market has to drop below the buy line or 10% or more away from its 50-week closing high. And the parameters, again, are right here. And it has to close below the 50-week moving average. And that's just a little bit of a whipsaw filter to keep you from getting in and out a little too much. Now, on the buy side, it's a little bit more stringent. You need 2 weeks of Landry light, and it has to close above the buy line. And I'll walk you through a couple of buy signals here in just 1 second. The point I wanted to show you here with this brief update is that notice that the 50-week line here, the buy line, has begun to drop. And the reason is that the look back is 50 weeks in time. And you can see, so that would be this closing high. Now, after 50 weeks, this high would be the highest close, and it's starting to drop accordingly. So the buy line is starting to catch up with price. Now, this is a really cool thing. I know you're going to party with me, but this is a really cool thing in bear markets that are a process type of bottom as opposed to an event type of bottom. So let me show you that real quick. So flipping over to the weekly chart, let me show you the buy signals. The buy signal, you need 2 lows greater than the moving average. So this was actually a buy signal here. And I didn't recognize it as a buy signal simply because I noticed that the market had already come back in, and I assumed that it was touching the moving average. But technically, this was a buy signal. And if you took that, then you ended up with a little bit of a whipsaw, but that's okay. At least it got you out the market fairly quickly before this big slide began to happen. Now, let me show you the event bottoms versus process bottoms, and then we'll take a look at the Landry light. So the pandemic was more of an event type of bottom. The market imploded and then went straight back up. So notice the buy line didn't have time to catch up to the market. Now, when you're watching a system like this, notice that it did get you out. There's a sell right there fairly quickly. In fact, the first week the market imploded, this system triggered, and you need to exit, no questions asked, if you're following the system, of course. But from what I've seen, it's usually a good time to get out of the market's way when that happens. Remember, for markets to drop 50%, in this case it dropped 30-something%, it's going to drop 10% first. And again, we use the 50-week simple moving average as a whipsaw filter. Now, the upside whipsaw filter is a little bit more stringent. You need 2 weeks of Landry light. Now, in this case, you can see it got you out here and it got you back in a little bit higher here as opposed to getting you in further down. But that's okay. We had other systems and other trend qualifiers that we watch, and I'll show you those in just 1 second. So let's go back to more of a process type of bottom. And you can just drag these charts along. And by the way, I want to do a show one day just on this. If you come up with a little system on your own, instead of trying to program it mechanically, just go in and bar by bar take a look at what happens. Now, there's a few things you need to be careful about. You got to be careful that you're not getting a little bit of a look ahead, but we'll get to that in upcoming shows. But anyway, you can see that 2008 was more of a process type of bottom. It took a while to happen. So you can see the buy line did begin to drop. If we go all the way back to 2003, it's a little bit more extreme example because it took about 2 years for this market to really bottom out, and we stayed in this bear market for a long time, about 3 years or so. And as you can see, the buy line dropped for a long time, and then it got you in at low levels. So it's a great system for a process type of bottom, not as good for an event type of bottom. And so the good news I'm trying to explain here, or trying to get across here, is that we've been in this bear market for so long, maybe we're due for this bear market to end. You can see that the buy line again is beginning to catch up with price, and we might get a buy signal here in the next month or so. So we need to pay attention to that. Now, when you do have a market that begins to sell off, don't sit around and wait for a weekly signal if you think about getting out, although this weekly signal does a good job of getting you out. By that I mean, let's just take a look at something like bow ties. So if you're waiting for bow tie proper order and you're on a weekly chart, you need to be careful because it might take a while for those bow ties to catch up. So if we take a look at proper order in a weekly chart in the S&P 500, you can see coming into the pandemic, we had uptrend proper order, 10 greater than 20 and 20 greater than 30, 10 simple, 20 exponential, and 30 exponential moving averages. And they did flip over to downtrend proper order, but notice that was really late. So this signal would have gotten you out the market really late. Now, the weekly TFM 10% system would have triggered on this first week, as I said earlier, so that would have gotten you out of the way. But as far as getting back in, once you get into a longer-term prolonged bear market, then something like the TFM 10% system can work quite nicely. Now, you might want to pay attention to other signals, such as daily bow ties, to see if the market is trying to make a turn. So you can see the bow tie moving averages went from uptrend proper order to downtrend proper order in early 2022, and that was obviously the beginning of the bear market. Now, always look at price when you're looking at these indicators. So it was green in here, but you could see that it did top out and roll right back over. So just because it's green doesn't mean you want to buy. But now I think you could probably wait to get long overall for a TFM 10% buy signal. But again, make sure you're looking at different time frames and different ways of looking at the trend. And of course, always look at the net price change. And that comes with by simply looking at the TFM 10% system and the buy line. So hopefully that made some sense. I've done some other shows on market timing. Go in and dig those out if you get really bored. And I have all the rules in the slides if you want to go in and look at some of the older slides and get those rules for these systems. Well, that's it for this week. Again, if you need follow-up information, dailyline.com/StockCharts. I'll give you the slides. To all my prior presentations, which again contain all the rules to the systems and setups. And if you need to reach me, dailyline.com/contact. I want to thank everybody for watching, and may the trend be with you.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.